Hello, welcome to lecture 6. I just want to say good job on the quiz. I think you guys did pretty well given how difficult it was. In the future, I'm going to add more time to the quizzes. I'm going to give maybe like 3 minutes per question instead of like the 2 that I have been giving. Hopefully that'll go over a little bit better. In this lecture, I'm going to be going over the PowerPoints. There isn't a lot to write. It's mostly just discussion and lecture, so I didn't really think we needed the paper and the pen approach for this one. We're going to be covering chapter 16. I know it says chapter 29 on here, but in the book it's chapter 16, the monetary system. The monetary system is how our money works in society. To engage in market activity, money is a necessity. When you buy a pair of shoes, the shoe salesman is happy to take your paper dollars. That's a little strange, right? He'll give you shoes that you can use to run, to walk around in, to protect your feet for just some paper rectangles. I think that's pretty odd. Why would the shoe salesman participate in this trade, in this market activity? Well, he's confident that the dollars you give him will be wanted and accepted by a third person in the future in exchange for something that he may want, right? A good or service. And that third person will only accept the trade if he is confident that a fourth person will accept the money, and so on. So to all the people participating in the market and in society, the cash, the check, the debit card, the credit card, whatever it is a representation, or it represents a claim to goods and services in the future. If I hand the shoesman $10, he knows in the future he can get $10 worth of good or services. Now let's start off with an economy with no money. They have to rely on bartering. This is usually a barter economy or a bartering economy. In this scenario, things are going to be a little bit rougher. Let's say I have cookies and I really want peanut butter. Well, not only do I have to go around and find somebody, they need to want cookies and I have to want peanut butter, and we have to find each other in the market. This is called a double coincidence of wants, and it's really hard. It's exhausting to go go door to door finding somebody who has peanut butter and then asking them if they want cookies, maybe trying to barter with them like, "Oh, I have a lot of cookies, you want these?" Maybe they don't. If I go to a restaurant, right, in a barter economy, and I want to eat a meal, what do I have to offer them? I have to offer them something of immediate value. I'm washing dishes, maybe giving them a recipe for a food, or maybe how to improve some food. Don't know how well that'll go over. Mow their lawn or offer them clothes right then and there. Well, what if the restaurateur didn't want any of those things? Well, then I guess I just don't eat, right? In a barter economy, trade is an unlikely occurrence because two people each have to have a good or service that the other one wants. It makes trade very difficult. And if you remember from lecture 1, one of the principles was trade can make everyone better off. Well, that's where money comes in. Money is going to make trade easier. It's going to grease the wheels of trading. The restaurant's not going to care if I couldn't produce a good or service to them right at that time. It's going to be happy to accept the cash, knowing that other people or businesses will do the same in the future. That's kind of the intro for this chapter. We're going to be covering what money is, the various forms it takes, how the banking system helps create money, and how the government controls the quantity of money in circulations. Money can mean different things. When we say Jeff Bezos has a lot of money, we mean that he is wealthy. Economists define money as a set of assets in the economy that people regularly use to buy goods and services from each other. With this definition, Jeff Bezos, his wealth would not count as money. Most of it's going to be tied up in assets like stocks or bonds or businesses and things like that, not necessarily cash. If we want to say how much money he actually has, he may not have a lot of money. Well, he probably does have a lot of money, but relative to his total worth, the amount of money he has might be pretty small. Now let's go into the functions of money. Money has three functions. The first being a medium of exchange. A medium of exchange is an item that buyers give to sellers when they purchase a good or service. When you walk into a store to purchase something, you are confident that the cash in your wallet will be accepted because cash is the commonly accepted medium of exchange. So this is the part where it's greasing the wheels of an economy and allowing trade to happen. I give you a few dollars, you give that another person a few dollars, and we don't need to care what each other wants because we all want money. We all want cash or US currency, US dollars, any dollar, rubles. Now, the second purpose it has is as a unit of account. It's the yardstick people use to post prices and record debts. Think of almost any economic variable, and most are going to be recorded in dollar amounts. When measuring and recording economic value, we use money as the unit of account. So let's consider hamburgers and shirts. Let's say a hamburger costs $5 and a shirt costs $50. What we did right there was to use dollars as a unit of account. We could say that a shirt is worth 10 hamburgers, right? Because it's $50 and the hamburger is $5. Everybody knows that a shirt is 10 hamburgers, and that's our accurate representation of what a shirt is worth compared to a hamburger. Well, this might get a little bit confusing if, the price of hamburgers change and we have to figure out how many hamburgers is a shirt now, and maybe there's so many different goods we might have to agree on what good or service to record things in. That's why debts and things aren't going to be recorded in goods and services. They're going to be recorded as through our currency or our money. Where they're going to say a hamburger costs $5 and a shirt costs $50, and we understand what the relative price or the relative worth or value is of those things. Last function that money serves is as a store of value. A store of value is an item that people can use to transfer purchasing power from the present to the future. A seller can accept money today in exchange for a good or service in the future. The seller can hold the money, right? The seller will hold the money and become a buyer of another good or service at a later date. Now, money is not the only store of value. Non-monetary assets like stocks and bonds can be a store of value. Wealth is referred to as the total store of value one person will have. So Jeff Bezos has a lot of store of value, even though he may have a relatively little amount of money. You can see how with store of value, right, it's saying this is how much your good is worth. Well, inflation might cause a problem with store of value. The money you receive today from an exchange of good or service may not be able to buy the same good or service in the future, tomorrow. If inflation is really high, money is going to be a poorer state of value. Now, other stores of value like stocks and bonds, houses, or other assets might be a better store of value, and that may resist inflation, but they might have other problems that decrease the value. Like if you have a house or a car, you might have depreciation instead of inflation. The house is decaying or the car is having wear and tear, so it decreases in value over time. Next, we're going to go on to liquidity. Liquidity is used to describe the ease with which an asset can be converted into the economy's medium of exchange. And our cash, the American dollar, the money is the most liquid asset. because it is the economy's medium of exchange. It's what we use to trade. Most stocks and bonds can be sold easily. If you think about the money in your bank account, savings account, those are going to be slightly harder to access than just having cash on hand. You might have to write a check or use your debit card. There's like a process to get that money. Maybe you go to the ATM and pull it out. So that's going to be a little bit less liquid than the money. And then at the other end of the spectrum, you might have something like a house or a car that they are valuable, but it's really hard to be, it takes a while for it to be sold, and it's not very liquid to get it into the cash form of, or selling your house. If you, or a painting also, it's going to take time and effort to unload those goods, and that makes them not very liquid. Now, people have to decide how to split their wealth between these liquid and non-liquid assets. They want to have some amount of money, the most liquid choice, so that they can purchase goods and service with it relatively soon in the near future, but they don't want all of their wealth to be money because it's going to be a weaker store of value than stocks, bonds, or a house. If prices rise, the value of money is going to fall. So they want to allocate their money somewhere in between, because if they allocate their entire wealth into good stores of value, like say they put all their money into houses, then they cannot purchase a good or service without going through another transaction, right? If they want to buy a hamburger, well, first they have to sell a house. They have to go through the whole process of selling a house to buy a hamburger. So you don't want all your money in really good stores of value, and you don't want all your money to be in the most liquid form of cash. Now, there are different kinds of money. Throughout history, there have been many different kinds of money used and observed. There are like 900 books just covering the last 100 years. Oh, sorry, 900 pages of just the last 100 years in America. So you can imagine how much information there is of money throughout the ages and the history. So when the first form of money we're going to talk about is called commodity money. It's money that takes the form of a commodity with intrinsic value. Intrinsic value means that it would have value or worth outside of being money. Examples, the best one being gold. Gold can be used in different industries. You can make jewelry with it, or you can make it in some sort of like electrical components. It's a rare metal, so it's going to be used to make things in production, but it can also be used if you're like, back in the old days we used gold to trade for things. Like you'd go to the miners. Miners would sift for gold. Once they find gold, they would use it to buy things. Or if you think further back with like pirates and stuff, they would use gold coins as a measure of value, and they would buy goods and services with gold. When an economy is operating using gold or dollars backed by gold, we say that it's operating under the gold standard. The US had the gold standard until Richard Nixon took us off the gold standard, I think in like the early 70s. Now, there are other types of commodity, right? Gold is a very good example, but maybe one you may not think of is cigarettes. What kind of money would be used in a prison? In prisons, they want to use a type of commodity money. They don't really have like fiat money. They're not going to, print money. What kind of money is used in prisons? In prisons, there often use commodity monies or types of monies. Cigarettes can be smoked, so you can smoke them and enjoy the cigarette. But they can also be used as money in a prison. when in exchange for a good or service, if you need protection, maybe you can give them cigarettes to protect you from the prison bully, or if you want to trade for some other good like a magazine or to try to sneak something in, you use cigarettes to trade. In the Soviet Union, when it was crumbling in the late 1980s, Moscow preferred using cigarettes as money instead of the ruble, which is their national currency. The ruble was the national currency of the USSR, and they switched off from that to using cigarettes. In either cases, whether it's the prison or in Moscow, even non-smokers are happy to accept cigarettes in exchange for a good or service, knowing that they can use cigarettes to buy other goods and services. Money without intrinsic value, we're going to call fiat money. This is what we have. This is what the United States uses. A fiat is an order or decree. Fiat money is established as money by government decree. This is basically monopoly money. It's just paper. There's no value or use to it outside of what the government and its citizens agree on. Why can the United States dollar purchase a good or service, but monopoly money cannot? It's just as simple as the government said that the US dollar is worth more than the monopoly money. It's worth $1. It's worth whatever amount of goods or service. Well, if you look at any dollar, it's going to say on it that this note is legal tender for all debts public and private, which is basically the government saying this is what we're going to use for government or economic, not government, economic activity. Fiat money is based on two principles. The first is that the government is central to establishing and regulating fiat money. The second is that its citizens' expectations and social convention as government decrees. So basically that the citizens agree with the government that they're going to use this currency for their economic activity. The first is that the government and the citizens have faith that the government's going to regulate it and establish this money as the premier way of handling transactions and trade. Now, the Soviets never abandoned the ruble, but its people did. They were uncertain about what was happening to the government, whether the ruble was going to maintain its value in the future. So they decided to use cigarettes because they were more confident that cigarettes would be accepted by others in the future. Now, last chapter, we discussed in little about how the money stock or the quantity of money last chapter we discussed in part or in a little bit about the money stock or the quantity of money circulating in the economy. It has powerful influence on economic variables, but what is the quantity of money? What is the money stock? What is included in this term? Is it cash? Well, yeah, it's going to be cash, but is it any asset that we have? Is it the house? Is it the cars? Where do we draw the line on what money is and what counts as the money supply? Well, we're going to include paper dollars and we're going to include coins, so the currency is definitely going to be included. We're also going to include balances in the bank accounts. It's going to be included as well, so those will be called our demand deposits. Now, it is clear that money and coins should be included, but maybe not all assets should be. We say that the bank deposits are, but other stores of value aren't. Like the Empire State Building is not going to be considered, for example. That's something we would not consider for the money supply, but we would consider cash and dollars. So there's a separation. There's a separation in the money stock, M1 and M2. So M1 is going to have our demand deposits, traveler's checks, other checkable deposits, our currency, of course. M2 is everything in M1, but it's also going to add in saving deposits, small time deposits, money market mutual funds, and a few other minor categories. It's not super important for our discussion, the differences between M1 and M2, but knowing what our money is, the roles it plays, and the different types of monies available are important. So that kind of just covers what is the money stock. It's just going to be basically our checking accounts, our currency, not much else. Not cars, or what else we have. Here we can see that M2 is significantly higher than M1. In this case study, we can say, where is all the currency? In January 2019, there was 1.7 trillion currency outstanding. This implies that average adult holds 6,500 currency, but that doesn't really make a lot of sense. Most of us don't have $6,500 of cash on hand. That's because most of the currency is held abroad by foreign speculators or foreign governments wanting to have some amount of US dollars in their treasuries. And it's also possible that the black market holds a lot of this money because drug dealers don't want to put their money into banks. They don't want to put it into other assets because they want to evade the IRS and they don't want to be tracked through that method. So they're just going to hold on to a bunch of cash, and it's going to be the best way for them to basically conduct their economic activities of selling drugs, weapons, or buy services, whatever they're doing. So that's where most of our money might be, or our money supply, money stock. But again, currency is not a good way to hold wealth. It's not going to earn interest. If you buy stocks and bonds, that will earn you interest. So if you just have a stack of cash, it could be lost, stolen, and it's not increasing in value. It's actually decreasing because of inflation. So that's going to cover where all the currency is. Now next we're going into the Federal Reserve System, and this is going to be the big takeaway from this lecture. The Federal Reserve System is the United States Central Bank, and it's a system that uses fiat money. There needs to be an agency that's going to regulate that money, and that's the Federal Reserve. We call it the Fed for short, so FED. The Fed is an institution designed to oversee the banking system and regulate the quantity of money. Japan, England, and Europe, they all have their own central banks. Ours was created in 1913 under President Woodrow Wilson. It's structured as having a board of governors and then a chair who would be like the leader. I guess he kind of oversees the meetings and things. These board of governors are elected by the president and have to be approved by the Senate. And they also serve very long terms, 14 years. The chair only serves 4 years, but the board will serve 14 years. And this is to avoid short-term political pressure. So if they need to make a decision that might harm the economy in the short term for a long-run goal or a long-run success, they don't have to worry about not making it into the next term or getting reelected, so to speak. So it's very similar to the judicial system, whereas judges aren't reelected and most of the time they have their position for the rest of their life, and that's so that they can make decisions without the repercussions of losing their jobs. This covers the Board of Governors. Right now our chairman is Jerome Powell. He was appointed by President Trump. The Fed has a few roles. They have a few jobs. They are the lender of last resort, which means that they are the bank's bank. If a bank is short on cash and needs money, They take loans out from the Federal Reserve, and they're also responsible for regulating banks and ensure the health of the banking system in the United States. Probably the most important, however, is to control the money supply. Decisions by policymakers concerning the money supply constitute monetary policy. So if you hear monetary policy, when I talk about monetary policy, think Federal Reserve and manipulating the money supply. Every 6 weeks, the Fed meets in the Federal Open Market Committee and discusses the economy and consider changes. So they gather and they set their goals, what they want to do. And do they want to target unemployment? Do they want to prevent or control inflation? What do they want the interest rates to be at? And so on. Once they have the answers to these questions, they are going to enact monetary policy to achieve these actions. They're either going to increase the money supply or decrease it. The primary method in which they engage in monetary policy is through buying or selling US government bonds. If they want to increase monetary policy, they print money and purchase bonds, which increases the money supply to the public. They buy the bonds from the public, which puts cash into the hands of the public, and then they have more money. When they want to decrease the money supply, they're going to do the opposite. They're going to sell bonds. They're going to sell bonds to the public. They're going to be given money from the public, and this is going to be taking money out of the hands from the public. These open market operations control the money supply. If you recall from lecture 1, if a government prints too much money, it's going to cause inflation. And there is a short-run trade-off between unemployment and inflation. These are the two principles that the power of the Fed is based off of. Their decisions are key determinants of inflation in the long run and employment and production in the short run. So the Fed has a lot of power to be influencing unemployment, GDP in the short run, or short run aggregate supply, and also long run inflation, or the price level. The Fed chair has been called the second most powerful person in the United States, next to obviously the president. He has a lot of influence on our economy and has a lot of influence on what's happening on our day-to-day lives. Now let's talk about how banks work in the money supply. The first type of banking I'm going to talk about is 100% reserve banking. And we're going to why we're looking at how banks react is because banks are going to influence the quantity of demand, and they're going to influence the money supply because of this. We'll go more into it a little bit later. Let's first talk about 100% reserve banking. So in this case, in this banking style, you're going to go to a bank with $100. $100 of your money. You're going to deposit that money into a bank, right? Deposits are what? Okay. In this case, you're going to a bank and deposit $100 of your money. So their deposits are the money that the bank is now holding for you. Now, deposits that banks have received but not loaned out are called reserves. So you deposit $100, now the bank has $100 worth of reserves. The $100 is going to be kept until you withdraw it in a 100% reserve banking. They keep 100% of your money in the banking. Now, looking at this T account at the bottom where it says First National Bank and it shows assets and liabilities, we can see that the assets are equal to its liabilities, and we know that it's a balance sheet. In reality, banks don't actually do this 100% reserve banking. It's kind of the most simple idea of what a bank does. But banks are a bit more complex than that, and they actually do what we call fractional reserve banking. Fractional reserve banking is when they loan out some of their deposits and collect interest on the loan for profit or to have to for the banks processing things like credit unions are non-profit banks, so they do loans, and once they loan it out, it's just to cover their costs of like the tellers and the CEO and everybody who's working for them. Now the bank needs to keep some of the money in its reserves in case anybody comes and wants to withdraw it at any given time. But they don't need to have it all readily available. The fraction of total deposits a bank holds as reserves is called the reserves ratio. So if they're lending out $10, then the reserve, if they're lending out $90 of the 100 you gave, the reserve ratio is going to be 1/10 or 10% because they're only holding 10% of your deposit, or a tenth of it, right? There's only 10%. This reserve ratio is influenced by government regulation and bank policy. The Fed will set a reserve requirement, which would be the minimum reserve amount that banks can hold. If they choose to hold more, that's just going to be their excess reserves. They don't need to hold more. So let's look at the T accounts again. So here we deposit 100, right? And then it loaned out $90. It kept its 10% reserve ratio. So they kept $10 in the bank, loaned out $90 to some guy outside, and its liabilities, what it owes to the person who deposited the money, is $100. Now, let's think about what happens in the money supply when it loans out $90. So the first guy who deposits the money has $100 in his bank account. The second guy who got the loan for $90 has $90 cash to buy goods or services. So what's the money supply? Is it still 100? Well, the money supply, if we remember, is going to be the demand deposits and the cash that's out in the world. So the demand deposits for the first guy is 100 because he deposited 100 into his account, and the cash that's out in the world is the $90 from the loan. So the money supply is $190, which is much higher than the original 100. The bank created money and influenced the money supply. This may seem odd. How can the bank create money out of thin air? Well, consider that now the wealth that is generated in this economy. Let's consider the wealth that's in this economy. The borrow from the bank has to be returned. So the $90 that was loaned out is going to be returned. And it may have allowed him temporarily to purchase more goods and services at the time. When he pays it back, he's no more wealthier than before. So the bank created an asset of money, right? It had the demand deposit and the cash out, but the bank didn't create any wealth. Now, what the bank does do is it creates a more liquid economy, because now the person who took out the loan, he can buy goods and services, and it's going to allow money to flow easier through trade or through economic activity. This is going to move us to our money multiplier. Let's consider our example here. Let's consider our example of depositing $100. And the first guy deposits it in the first bank. He deposits $100. The first bank loans out $90 to the second guy. Well, what is he going to do with his newfound money? He's going to deposit his check or his cash into his bank account. Then that bank is like, dang, I should loan out this money. And the third person puts his money into the third bank. And the third bank is like, oh, smokes, is this money? I should loan this out, and so on. So every bank is going to get some money, and it's going to basically multiply the amount of money. Now, it may seem like this might go on forever, right? Because the first person puts in $100, the second person gets a loan of $90 because of the 10% reserve requirement. So you can only loan out $90. So the second person has $90, he deposits it into his bank, and then they're going to loan out 90% of their deposits. So 90% of 90 is going to be 81, right? We can see that in the assets of loans. He's going to loan the $81 out to the third person. The third person's going to deposit it into his bank. That bank is now going to have $81. They're going to deposit 90% of that. So they're going to deposit they're going to loan out $72.90. And you can see if we add up all the money in the money supply now, it's going to be much higher than 190 because we've already added another $150. So now we're at like $340, which is way above the original $100 that we just started in the 100% reserve case. Well, what is our money multiplier? Well, how much money does it create? Because I know it seems like it can go on forever, and technically, like mathematically, you can keep on dividing it and it would go for until, time runs out or infinity, what have you. But, banks aren't going to deal with 0.0000 cents because that's not going to net them any real money or, wealth. So let's figure out how we get this number. Let's add up all the reserves in our example. So our first deposit was 100, and then 90, and then 81, and then 72.90. And if you do the summation and you do the math, there's a formula for it. It's going to add up to $1,000. Well, this means our money multiplier is 10. We started with 100 in our money supply, and now our total money supply is 1,000. So we multiplied our money by 10. Well, how do we do this in real life? How do we calculate this? We're not going to go through every bank, figure out who the original deposit is, and that'd be a nightmare to do, right? Well, it turns out there's a much easier way to actually calculate the money multiplier. If we take the reciprocal of our reserve ratio, we'll have our money multiplier. What was our reserve ratio in this case? If you remember, it's 10%. So 10%, if we take the reciprocal, 1 over 10, it's going to be 10 over 1, which is going to be 10. The higher the reserve ratio, the less money banks loan out and the smaller the money multiplier. If they can only loan out 10, let's reverse it. Let's say that our reserve ratio is 80%. That means banks can only loan out 20%. Our money multiplier is going to be 1.25. We only increased the money supply by 25% instead of 10,000%. So now we know more about the banking and how banks influence the money supply. We can see that the Fed has indirect control of the money supply because the Fed has to consider how the banks are going to respond and act. Even if they set the reserve ratio to 10%, well, banks can maybe loan out to 60% only, right? And then they keep 40% as a reserve. So the Fed doesn't have direct control over the money supply because they have to account for how banks will respond and how they're going to act. Now we're going to go into the Fed's tools of monetary policy. We're going to skip this financial crisis of 2008, 2009. If you want to look at it, be my guest. The first part the first tool that the Fed has of monetary control is what we already discussed, the open market operations. They're going to buy bonds to increase the money supply and sell bonds to decrease the money supply. The next tool is lending to banks. Banks borrow from the Fed when they feel they do not have enough reserves on hand to satisfy bank regulators, or meet deposit withdrawals, make new loans, or, for whatever business reason they could have, whatever banks want to do with the money. Traditionally, banks borrowed from the Fed's discount window and paid an interest rate called the discount rate. The banks respond to the discount rate the same as anyone else. A higher discount rate discourages banks borrowing from the Fed, reducing the quantity of reserves in the banking system and in turn reducing the money supply. A lower discount rate will encourage banks to borrow and increase the money supply. It also lends to financial institutions when they're in trouble. If Wall Street brokerage firms will borrow from the Fed if a stock market just crashes, as an example. So the bank will lend to, or the Fed will lend to banks, and it will also lend to some financial institutions during certain times. So we covered open market regulations, Fed lending to banks, discount rate. The auction is just how the Fed operates now. So instead of going to the discount window, they hold these auctions every year, and to banks. So banks come to them and they bid up the interest rate, and then they get the most consumer surplus from the banks this way. So they pay the highest interest rate instead of just whatever the discount rate would be at the teller window. We know that the reserve rate determines the money multiplier. So looking at the next tool, how the Fed influences the reserve ratio. If the Fed can influence the reserve ratio, it's going to further exert its control over the money supply, because the reserve ratio is going to determine the money multiplier. So if they can decrease the reserve ratio, for example, that's going to increase the money multiplier, which is going to increase the money supply. One way to do this is just to alter the reserve requirement, because we know that the Fed sets the reserve requirement. They could just say, oh, you guys need to hold 20%, you guys need to hold 15%. They could just set the minimum amount of reserves banks must hold against their deposits. An increase in the reserve requirement means that banks loan out less because they have to, and it's going to decrease the money supply because the money multiplier is going to go down. The converse is also true. Decreasing the requirement was going to increase the money supply because the money multiplier increases. Now, this isn't a very common method because it's going to disrupt business of banking, and so they're not going to change the reserve requirement very often. The other way to influence reserve ratio is paying interest on reserves. Banks that hold an account at the Fed will have an interest on reserves. Think of this exactly like the savings rate you have at a bank. It's the exact same. The Federal Reserve is going to offer an interest rate if the bank holds the deposits, the reserves, just there. So they're just going to hold the money, and then the Fed is going to pay them interest on that, and the bank is going to be incentivized or encouraged not to loan out as much money. So when banks hold more money into the account, or when the Feds increase this interest rate on reserves, then it's going to lower the money multiplier and lower the money supplied, or the money in circulation. Now, there are a lot of problems controlling the money supply. These methods aren't very precise. They're not a precise measure. They don't target a specific dollar amount they want in circulation and just go for it, right? It's going to be extremely difficult considering fractional banking, the money multiplier, black market operations, and household choices. households are not influenced by the Fed. The Fed has little control on the amount of money households choose to put into a bank. The more money they put into banks, right, the more money households decide to put into their checkings and savings deposits, the more the bank can loan out, and that's going to increase the money supply. But households don't have to do that. In fact, sometimes households may take out their money from a bank. One issue that can occur is called a bank run or a run on the banks. This is famous and a relatively common event that occurs when consumers lose confidence in the banking system and run to the banks to withdraw their money. This happens usually in the wake of a recession. Like in the beginning of the Great Depression, many people ran to the banks to withdraw their money, and banks were forced to close, and a lot of people were out of their money because banks close because they have no money to give back. They ran out of their reserves because they only kept 20%, and people were demanding all of their money out. So this reduced the money supply and really, really hurt the the flow of money within the economy. So during the Great Depression, during the time when there was a run on banks, Herbert Hoover had influence on monetary policy at the time, and he was scared of inflation. So they reduced the money supply, which exacerbated the issue that was going on. Because now the banks couldn't go to the Fed for help. They couldn't go borrow money from the Fed. The interest rates were really high. They had no money anyways. So it really halted economic activity at the time. You can see if you ever seen if you ever watched the movie It's a Wonderful Life, I highly recommend it. It's kind of about the Great Depression at the time, where this guy, he works at a bank and there's a run on the banks, and he's considering whether or not to kill himself for insurance money that his family can get, and I think there's like an angel that tries to stop him. But it's a good representation of kind of what was happening during the time, and really demonstrates this idea really well. And it also happens and is displayed in Mary Poppins. But after withdrawing their deposits, these households preferred to hold on to their currency, and banks weren't able to loan out, and there's basically no flow of dollars in the economy, which is why the Great Depression was so bad. The second problem is the Fed does not choose the amount banks lend. The Fed can't be sure how much of the bank's deposit is going to be loaned out or how much money is going to be created. If bankers are concerned about economic conditions, they may not loan out as much. The reserve requirement may be at 10%, but again, the bank may only lend out 50%. So if banks behave in a certain way or have certain beliefs about what's going to happen in the future, the Fed may not be able to influence the banks the way they want to by lowering the reserve ratio or by increasing their interest rates and so on. In this case, right, banks would create less than otherwise would because they're not loaning out as much. And then the very last thing we need to talk about is the federal funds rate. The federal funds rate is the interest rate at which banks make overnight loans to one another. Now, if one bank is short on reserves and another one has excess, the second bank, the one with excess reserves, can lend some to the first. These loans are usually temporary and only last like a night or so, maybe a day. This price, the rate of interest that they charge, is called the federal funds rate. The Fed tries to set the federal funds rate. The reason is that these interest rates are highly connected with other interest rates. So if it rises or falls, other interest rates will follow. You can think about it, if the federal funds rate falls, it's likely your savings rate will also fall. So if your savings rate falls, you might want to maybe deposit less money, or if your saving rates increase, you might want to deposit more money. So the Fed tries to target certain federal fund rates, even though these federal funds rates are determined by market demand and market supply. They can also affect these federal funds rate by doing the open market operations, buying bonds and selling bonds. When the Fed buys bonds and increases the money supply, banks find it easier to have reserves and excess reserves, which is going to increase the supply of people having money to lend, and it's also going to lower the demand because less banks find themselves in need of a loan since they have an easier time meeting their reserve requirements. And more banks have reserves to lend. So it's going to shift the supply to the right, it's going to shift the demand to the left, so the interest rate is going to fall drastically. Right? It's going to be really low. So now we know how the Fed operates and how the money supply changes. This is going to cover lecture 6